Let's continue chapter 4, to continue with the contributions to a corporation. The next part after talking about assets, of course, is talking about liabilities. And so it says here, assumption of liabilities by a corporation does not result in boot to the transferor shareholder for gain recognition purposes. Instead, liabilities are treated as a boot for determining basis in the acquired stock. Basis of stock received is reduced by any amount of liabilities assumed by the corporation. So basis is reduced by liabilities assumed. So debts primarily would be what that is. Okay, so liabilities are not treated as boot for gain recognition unless, it always seems to be those unlesses, liabilities incurred for no business purpose or as tax avoidance mechanism. Of course, then that would be a different story. Then the boot would be the entire amount of the liability. Liabilities greater than basis and asset transferred. Then there's a gain recognized, the excess amount of liability minus basis. So there is the unless here, which I think the IRS is just trying to say, let's try to make sure people aren't trying to hide taxes or avoid taxes by doing this. So example of formation with liabilities here. So we're going back to property transferred with a fair market value of 150, the basis of 100 with a gain of 50, then liabilities assumed by the corporation, business purpose 1, business purpose 2, and then no business purpose at all. So we've got the 80,000, 120, or 120. And so here is then the three possible scenarios. The first one, business purpose 1, fair market value of stock received is 70, liabilities assumed is 80, amount realized is 150, basis transferred is 100, gain loss is 50. And the second one, it's fair market value received is 30, liabilities assumed of 120, fair market value, basis of property transfer is 100, gain loss of 50. So they all result in 150. Over here, no business purpose, fair market value plus liabilities assumed minus the basis is also 50. Liabilities assumed by the corporation, independent facts then. So it says here for the first one, no boot, no gain recognized. The gain is lesser of 50,000 realized gain or boot. For the second one, no boot, 20,000 gain. And for the third one, no business purpose of 120 with a gain of 50. So this is just coming from your chapter 2, exhibit 4.1 from your chapter, and it's saying the basis the computation for 351 exchanges, adjusted basis plus gain recognized minus boot received minus adjustment for lost property gives you the basis of stock received. In exhibit 4.2 then, adjusted basis of property transferred plus gain recognized minus adjustments gives you the basis of property to corporation. So corporation's basis and assets received in last example, liabilities assumed by the corporation. These are all independent of each other. So we've got liabilities of 80, 120, and 120. Business purposes for the first two, none for the third. The basis of transferred assets are the same for all, and then the gain recognized by shareholder and the basis to the corporation. You can see what the examples are there. Adjusted basis of transferred assets is 100,000. Liabilities assumed are as independent facts, 80, 120, and 120. The third one, of course, being the no business purpose. And so basis and assets transferred is the 100,000. Plus gain recognized, it's 0, 20, or 50, minus liabilities transferred to the 80, 120, or 120, gives us a basis of either 20, 0, or 30. The basis adjustment for lost property when built-in property is contributed to a corporation. The aggregate basis in property may have to be stepped down, so basis does not exceed fair market value of property transferred. Necessary to prevent parties from obtaining double benefit from losses received. That's part of that tax avoidance. That's part of what that is about. Step down in basis allocated among assets with built-in losses. Alternatively, shareholder and corporation both elect, if they both elect, The basis reduction can be made to the shareholder's stock. Built-in loss adjustment places loss with either the shareholder or the corporation, but not both, because that would be a double benefit if you did that. Okay, so now let's talk about stock issued for services rendered. Okay, stock issued for services rendered. A corporation may be able to deduct the fair market value of stock issued in exchange for services as a business expense. Okay, so the performance of a management services may claim a compensation expense deduction under Section 162. If the services are such that payment is characterized as capital expenditures, legal services and organizing the corporation must capitalize the amount as an organizational expenditure. Okay, so holding period of stock received for capital assets or Section 1231 property include holding period of property transferred to corporations. For other property begins on day after exchange. The corporation's holding period for property acquired in the transfer is holding period of transfer. A Section 351 transfer where no gain is recognized, the depreciation recapture rules do not apply. Recapture potential associated with the property carries over to the corporation. Capital contributions, no gain or loss is recognized by a corporation on receipt of money or property in exchange for its stock. Applies to additional voluntary pro rata contributions of money or property to a corp even though no additional shares are issued. Capital contributions of property by non-shareholders are not taxable to the corporation. The basis of property received from a non-shareholder is zero. That's kind of a key thing to remember, I believe. So it's capital contributions, non-shareholders, not taxable to the corporation. Basis received from a non-shareholder now becomes zero. Capital contributions of cash by a non-shareholder, so non-shareholder contributing cash, must reduce basis of asset acquired during 12-month period following contribution. Any remaining amount reduces basis of other property owned by the corporation, applied in the following order to depreciable property, then amortizable property, then assets that are depleted, and then other remaining properties after that. So we allocate those in that order. Debt versus equity of a corporation. Corporations pay interest to debt holders, which is deductible by the corporation. That's kind of what part of the corporate form, one advantage is that the debt interest payments are all tax deductible. Interest paid is taxable as ordinary income to individual or corporate recipients. So again, so the corporation is paying interest, it deducts the interest from to compute taxes. Whoever receives the interest, it's interest income to that party, another corporation or individual. Loan repayments are not taxable to investors unless repayment exceeds basis. So principal principal payments are not taxable unless you pay more principal than the basis on the loan. Equity, corporations pay dividends which are not deductible. That's a key thing to remember. Sometimes, that's why corporations choose to go with debt financing above issuing stocks, is because they get that tax deduction. Dividends are not tax deductible. Taxable to individuals at low capital gain rates to extent the corporation has earnings or profits. Corporate shareholders may receive dividends, receive deductions. So again, we've talked about that in previous chapters, that to avoid triple taxation, corporations that own stocks that pay dividends can deduct a certain amount of the dividends received. The dividend received deduction is all based on how much income you have. We talked about that in chapter 3, I believe. Reclassification of debt as equity. If a corporation is very thinly capitalized, it has too much debt and too little equity, the IRS may argue that debt is really equity and deny tax advantages for debt financing. If debt has too many features of a stock, principal interest payments may be treated as dividends. So just some rules to think about regarding how you choose to capitalize your corporation between debt versus equity, and what types of debt instruments that you choose to use and equity instruments that you choose to use, if you've got convertible bonds or some things like that. Debt instrument documentation, debt terms, what the reasonable rate of interest and definite maturity dates are, timeliness of repayment of debt, and then whether payments are contingent on earnings. So clearly most debt payments are not contingent on earnings, but dividend payments are. So the IRS is trying to make sure that a corporation can't basically hide what really should be dividend payments as interest payments, because interest payments are tax deductible, dividend payments are not. That's really what they're trying to get to. Is the debt subordinated to other liabilities, whether debt and stock holdings are proportionate? In other words, you have a whole bunch of one versus the other. Use of funds, if used to finance initial operations or to acquire capital assets, looks like equity. And then the debt to equity ratio, because clearly to be a corporation you have to issue stock, right? I mean, you can't be a corporation without having stock issued. Most companies are issuing stock initially to be able to finance the organizational costs and the initial operations, and then at some point you may go out and borrow some more money or issue more shares of stock. So trying to get to the point where it's a company just trying to issue a whole bunch of debt and have very little capital because you get the tax advantage of the debt. They're trying to just keep a company from basically bending the rules too much to the side of debt and getting those tax advantages of the interest deductions. Okay, investor losses, stock and security losses. If stocks and bonds are capital assets, losses from worthlessness are also capital losses. So loss is treated as occurring on the last day of tax year in which they become worthless. No loss for a decline in value. So basically you only receive a loss if it goes bankrupt or has no value, or you sell it, of course, at a loss. If stocks and bonds are not capital assets, losses from worthlessness are ordinary losses, broker owned. Sometimes an ordinary loss is allowed for worthlessness of stock of an affiliated company. Business versus non-business bad debts. The general rule is losses on debt of corporations treated as business or non-business bad debt. If non-corporate person lends as investment, loss is non-business bad debt, which can result in short-term capital losses, only deductible when fully worthless. Must be fully worthless. Business versus non-business bad debts continued. If a corporation is a lender, loss is business bad debt. Ordinary loss deduction may apply. Deduction allowed for partial worthlessness. All bad debts of corporate lender qualify as business bad debts. Business versus non-business bad debts. Corporate lenders may qualify for business bad debt treatment if a loan is made in some capacity that qualifies as a trade or business, or shareholders in the business of lending money or buying, promoting, and selling the corporation. Okay, treatment of Section 1244 stock. Ordinary loss treatment or loss on stock of small business corporation. The gain is still a capital gain. 1244 stock applies to the first $1 million of the corporation's equity, of their stock I should say. If greater than $1 million of stock is issued, entity designates which shares qualify for the 1244 treatment. Property received in exchange for stock is valued at its adjusted basis, reduced by any liabilities assumed by the corporation. Annual loss limit of $50,000 or $100,000 if married filing a joint return. Any remaining loss is a capital loss. Any original shareholders of a 1244 stock qualifies for ordinary loss treatment. Sale or contribution of stock results in 1244 status. If 1244 stock is issued for property with basis greater than fair market value, for determining ordinary loss, stock base is reduced to fair market value on date of exchange. Non-corporate shareholders may exclude a portion of any gain from sale or exchange of such stock must have held stock for greater than 5 years and acquired stock as part of the original issue. So these are original shares. A 50% exclusion can be applied to the greater of $10 million or 10 times the shareholder's aggregate adjusted basis of qualified stock disposed of during the year. Qualified small business corp, a C corp with gross assets not greater than $50 million on date the stock is issued. Actively involved in a trade or business, at least 80% of corporate assets are used in the active conduct of one or more trade or business. The exclusion percent varies depending on when the qualified small business stock was acquired. 100% of gain is excluded for qualified stock after September 27, 2010. 75% between Feb 17 and September 28, 2010, and then 50% gain is excluded for qualified stock acquired before February 18, 2009. Okay, I'm skipping the big picture stuff. I'll let you guys look at that on your own. Let's just see. So we'll just kind of stop right there. So, just as usual with Chapter 4, it's a lot of rules that we have to know. I'm going to do a separate recording to walk us through several examples of the problem. I think that's where more of the learning really happens than me just talking about the chapter, because you can read the chapter, of course, you can look at the PowerPoints on your own, but I think the learning is when we do some problems together. So we'll do that next.